Ever pondered over what a second mortgage or home equity loan is? Well, you're not alone. Let's break it down. Home equity is the value of ownership you've built up in your property. Imagine it as the portion of your house that you genuinely own, the part that's not under the thumb of a mortgage. It's the current market value of your home, minus any outstanding mortgage payments. Now, this home equity isn't just a concept. It's a valuable financial asset, a golden egg, if you will, that can be put to work in various ways. You can leverage this equity to secure a loan, finance home improvements, consolidate debt, and much more. But like any financial move, it's not without its risks and rewards. So, it's crucial to tread carefully and make informed decisions. So, let's dive into the different types of home equity loans or second mortgages. Firstly, we have home equity loans, often referred to as second mortgages. These allow you to borrow a lump sum of money using your home's equity as collateral. The loan typically has a fixed interest rate and fixed monthly payments. This means you're not faced with any surprises along the way, making it easier to budget and plan your repayments. The uses of a home equity loan are as versatile as they are practical. You could use it for home improvements, debt consolidation, education expenses, or large purchases. It's like having a piggy bank, but instead of pennies and nickels, you're using the value of your home. One of the main advantages of a home equity loan is the lower interest rates compared to some other forms of borrowing. This is because your home acts as security for the loan, which typically translates to less risk for the lender and lower rates for you. Moreover, there's a potential for tax deductions on interest payments, making this an even more attractive option. However, it's not all sunshine and rainbows. With a home equity loan, your home is on the line. If you can't make payments, you risk losing your home. This is a significant consideration and one that should not be taken lightly. On top of your existing mortgage, you'll have additional monthly payments to make, which could put a strain on your finances. In essence, a home equity loan can be a powerful financial tool, offering you a way to leverage the value of your home for your financial needs. However, it's crucial to remember that it's not free money. It's a loan that needs to be repaid, and failure to do so could have severe consequences. While home equity loans can be beneficial, remember, there's always a risk of losing your home if you fail to make payments. It's important to think carefully, consider your financial situation, and consult with a financial advisor or mortgage specialist before making a decision. Next up, we have the home equity lines of credit, known as HELOC. Imagine a credit card, but instead of being backed by your promise to pay, it's backed by the equity in your home. That's what a HELOC is. It's a revolving line of credit that allows you to borrow money up to a certain limit. The limit is typically based on the equity you have in your home, which is the portion of your home that you truly own, once you've subtracted any outstanding mortgage payments from its current market value. So, when would you use a HELOC? It's typically used for ongoing expenses like home renovations or as a financial safety net. Maybe you're planning a series of home improvements over the next couple of years, or maybe you want to have access to funds in case of an emergency. Those are situations where a HELOC could come in handy. What makes a HELOC attractive? Well, one of the benefits of a HELOC is the flexible access to funds. You can draw from your HELOC over a set period of time, and you only pay interest on the amount you've drawn. Plus, during the draw period, you often have the option to make interest-only payments. And let's not forget the potential tax deductions on interest payments, making it a potentially cost-effective way to borrow. But just like anything else, HELOCs have their drawbacks. The interest rates on a HELOC are variable, meaning they can go up or down over time, which can make budgeting a bit of a challenge. And because your home is used as collateral, there's the risk of losing your home if you can't make the payments. There's also the potential for overspending since you have access to a large amount of money, which can lead to more debt if not managed responsibly. In a nutshell, HELOCs provide flexible access to funds, but the risk of home loss and potential overspending exists. It's crucial to consider these factors and your personal financial situation before deciding if a HELOC is the right option for you. Scene script. Another way to tap into your home equity is through a cash-out refinance. So what exactly is a cash-out refinance? Well, it's when you refinance your existing mortgage for an amount that's larger than what you currently owe, and then you receive the difference in cash. It's like getting a brand new mortgage, except this one is bigger and it pays off the old one. Now, why would you want to do that? Well, there are several reasons. For instance, you might want to use it for home improvements. If you've been dreaming of a new kitchen or an extra bathroom, this could be a way to finance it. Or maybe you've got a significant chunk of high-interest debt that you'd like to consolidate. A cash-out refinance could help you do that. It's also often used for major expenses like your child's college tuition or perhaps a once-in-a-lifetime family vacation. Sounds pretty good, right? And in many ways it is. One of the main benefits of a cash-out refinance is that it can potentially offer lower interest rates compared to other types of loans. And since you're replacing your old mortgage with a new one, you only have one monthly payment to worry about. Plus, just like with other types of home equity loans, there's the potential for tax deductions on your interest payments. But, as with anything, there are also downsides to consider. For starters, because you're borrowing more than your original mortgage, you'll have a higher loan amount. This could mean higher monthly payments, and it could take you longer to pay off your home. Not to mention, there's always the risk of losing your home if you can't make the payments. So, while a cash-out refinance can be a great tool for some homeowners, it's not for everyone. It's important to weigh the pros and cons, and to consider your financial situation and your long-term goals. A cash-out refinance can offer potentially lower interest rates, but it comes with a higher loan amount and longer repayment term. You can also access your home equity by selling your home at a profit. Now, this option may seem straightforward, but it's worth diving into the details. Home appreciation is the increase in the value of your property over time. It's like your home is a piggy bank quietly accumulating value as the years go by. But how do you access that growing value? One of the most direct ways is through a sale. When you sell your home, you can cash in on that appreciated value, effectively turning your equity into a tangible asset. Now, why would you choose this route? Well, typically this option comes into play when you're ready to make a significant life change, like moving to a new home or downsizing. It can also be a smart move if you're looking to eliminate debt entirely, as the money from the sale can be used to pay off your existing mortgage. But what's the catch? Well, selling your home realizes the full value of your equity, but it's not without its drawbacks. The process of selling can be time-consuming and expensive, with costs for things like home repairs, staging, and real estate agent fees. You may also face capital gains tax on the profit from the sale depending on your situation. And of course, selling means saying goodbye to your home, which may not be desired or feasible at a given time. So, let's weigh the pros and cons. On the upside, selling your home allows you to realize the full value of your equity without taking on additional debt. It can provide a substantial cash sum that you can use as you see fit, whether that's investing in a new property, funding your retirement, or pursuing other financial goals. On the downside, selling your home is a significant decision that requires careful thought and planning. It's a process that can take months, and it's not without costs. Plus, it might not be the right choice for everyone. If you love your home and your community, or if you're not ready for the upheaval of a move, other equity access options may be more suitable. Selling your home realizes the full value of your equity, but it might not always be the most desired or feasible option. It's a decision that should be made with careful consideration of your personal circumstances and long-term financial goals. Lastly, we have the reverse mortgage, an option available to seniors age 62 and older. Let's dive right into what a reverse mortgage is. In essence, a reverse mortgage allows homeowners to borrow against their home's equity without making monthly payments. Instead of the homeowner paying the lender pays the homeowner. The loan is then repaid when the borrower moves out, sells the home, or passes away. Now, why would someone choose a reverse mortgage? It's most commonly used to supplement retirement income or cover healthcare expenses. Imagine having a monthly stream of income, a lump sum, or having access to a line of credit to meet your needs, all while staying in your beloved home. Sounds appealing, right? And since there are no monthly payments required, it offers a certain degree of financial breathing room. But like all financial decisions, there are pros and cons to consider. On the upside, a reverse mortgage provides flexibility in how funds are received. It's a unique type of loan that puts you, the homeowner, in a position of choice. You can choose how you receive the funds, whether as a line of credit, monthly payments, or a lump sum. On the downside, reverse mortgages come with high upfront costs. These include origination fees, mortgage insurance premiums, and closing costs, which can add up quickly. Also, it's important to remember that a reverse mortgage may impact what you leave behind for your heirs, as the loan will need to be paid off when you pass away or sell your home. Moreover, eligibility for a reverse mortgage is limited. It's only available to homeowners who are at least 62 years old and have significant home equity. Plus, the home must be the borrower's primary residence. In conclusion, a reverse mortgage offers flexibility in how funds are received, but it comes with high upfront costs and limited eligibility. Like all home equity options, it's crucial to weigh the pros and cons and consult with a financial advisor before making a decision. So there you have it, a rundown of the different types of home equity loans and second mortgages. We've explored the ins and outs of home equity loans, or HELs, home equity lines of credit, also known as HELOCs, cash-out refinancing, home appreciation and sales, and reverse mortgages. Each option comes with its own set of benefits and potential pitfalls. CHELs and second mortgages offer lump sum borrowing, while HELOCs provide flexible access to funds. Cash-out refinancing can lower interest rates, and home appreciation and sales let you tap into your equity without additional debt. Reverse mortgages, designed for seniors, require no monthly payments. However, they all come with one major risk: losing your home if you can't make repayments. It's crucial to understand this risk and plan accordingly. Remember, using your home equity can be a strategic financial move, but it's essential to carefully consider your financial goals, assess your ability to repay the borrowed funds, and explore the various options available. Until next time, stay financially savvy.